Welcome. You're listening to The Best of Investing. I'm your host, Edward Brown, along with my co-host, Mark Hahn from NomFund of Pacific Private Money. Our phone number is 888-912-1190. You're going to use that number to answer the trivia questions for a 5-pack tanning certificate given away during the show. And that certificate's not sponsored by the radio station, but by Tan Bella Tanning Salon with 2 locations in San Francisco and 1 in Marin. Today's trivia theme is entertainment. All right, Mark, what do the pundits say?
The pundits, yes, I love that word. I have no idea what a pundit is, but they're saying a lot of stuff out there. Now, if you've listened to this show before, you know that I tend to come to the show with articles that generally discuss the resilience of the economy, and particularly the real estate market. And I just want to say, because I've got some more articles here, and it's mostly good news. And you know, I don't want people to think that we're just nothing more than, you know, a drumbeat for, you know, the real estate industry. It's not that at all. It's, I just think there's so much noise out there. And, you know, Nom and I and Edward, we subscribe to a lot of blogs. We see a lot of information out there. And there's a lot of smart people that are saying and writing things that get lost in the din of the headlines. Now, I'll tell you that every morning I wake up, I grab a cup of coffee, and there's 2 newspapers on my porch, the San Francisco Chronicle and the Marin Independent Journal, because I live in Marin County. And, you know, it's just really, other than just for the fact that it's a habit and it's how I wake up, I'm not a fan of the endless drone of horrifying headlines that you see in these newspapers, because, again, it's, you know, first of all, I don't really know that I trust the competence of the people who write some of these reports. And some of the headlines are very misleading. They don't even really, you know, pertain to the article within. And as you know, headlines are not written by the people who write the articles, generally speaking. So it's just, you know, we're trying to like separate the madness here and give you some real information. I'm going to start with our favorite at the Best of Investing. Our favorite California-based economist is Christopher Thornburg, one of the smarter people out there. And he wrote another blog post last week that says we're not in a typical recession. This recession will last as long as it takes for the virus to go away. And then in his opinion, things will go back to normal. And he goes on in his article to say, yes, we're in the midst of a recession, but the question is, how bad of a recession, and where is the economy going to be in the second half of the year? If you look at the headlines, you're hitting the panic button and are ready to go live on an island and wait this thing out, says Thornburg. But you should take a step back. When any kind of conversation is had, unfortunately, hysteria seems to be the new normal. He says we're not in a typical downturn. He says, has there been a collapsing financial bubble? No. Has there been a massive financial bubble in the U.S. economy? No. Did we see this coming a year away? No. In fact, much of this is an incredibly large negative shock to the system, but it is not a traditional business cycle in any way, shape, or form. So for all those folks leaping to the worst possible conclusions, they are leaping to assumptions that don't make sense. So to summarize Chris's blog post for the past week, he says none of the data suggests that we're in for a long-term downturn. None of this suggests that unemployment rates are staying elevated for a long period of time. The economy will continue to rebound at the speed that the virus goes away. It's as simple as that, in his opinion. When it does go away, we're going to go back to where we were at the start of all of this. So he's predicting that we're not likely to see you know, the normal business cycle, the normal business recession that many of us were wondering when it was going to hit 10 years into this recovery that we've been in. Prior to the coronavirus, we continued to push out that inevitable business cycle a couple of years. And what he's suggesting is that when coronavirus the impacts are stabilized, that we're very, very likely to see a continuation of good economic activity. So I find that I tend to put my money behind people who are smart and have proven themselves to be worth following. So I think this is pretty
is there
good news.
is there any caveat about if the virus situation lasts another 6 months or year?
Well, no, he's not. He's not predicting when the virus is going to end. Now,
No, what I mean is that like his prediction, my prediction is accurate unless this goes an extra year, and then
He's mentioned that in previous articles since March. His caveat has always been, you know, the X factor will be how long this virus stays around. But I totally get his point and believe it too, is that once things like a vaccine are found or better testing, then, you know, we'll get back to a little bit more of normalization.
Or we may just adapt, you know, and just change things a little bit. You know, restaurants may be more takeouts, you know, who knows?
Right.
I mean, they're like,
I do have concerns about what the government is going to do here on forward, depending on how long this partial shutdown of the economy lasts and whether they're going to start supporting those who can't make mortgage payments, those who can't make rent payments, and how about those people who lent the money that's not being served on the mortgage payment. So well, anyway, a lot of things to think about.
all right. We cut to our first commercial break here, our first trivia question on entertainment. What unusual item was worn by the Gong Show's unknown comic? Do you remember that from the 70s?
The Gong Show,
variety show where people would do their acts, and if they didn't do well, they get gonged, and if they did well, they'd make it to the next round. So what unusual item was worn by the Gong Show's unknown comic? Call 888-912-1190. The first caller with the correct answer is going to win that tanning certificate. And don't touch that dial. The Best of Investing will be right back. Welcome back to the Best of Investing. Edward Brown here, along with Mark Hanf and Nam Phan of Pacific Private Money. First trivia question. What unusual item was worn by the Gong Show's unknown comic? Nam, you know that.
A bag.
Yeah, that's right. He put a bag over his head. That's why he was the unknown comic. And
we thought maybe he was a Saints fan. Remember the New Orleans Saints years
that's
ago?
right. Well,
these were bags over their heads.
I think
they
that's
call themselves the Aints.
Yeah, that's where they
remember that.
Make a quick mention here for the Mount View Hotel and Spa in Calistoga. Enjoy the luxurious pool, hot spring mineral water jacuzzi as they provide social distancing in their large pool area. I don't know if you guys have ever been there, but it is a fantastic pool. Enjoy the magical themed dinners in their new private hotel guest outdoor dining area. Centrally located in Calistoga and within walking distance of many amenities, including the wineries. Check them out at www.mountviewhotel.com for reservations. Mark, you have a couple more articles you want to share.
I do. So we talked last segment about the economy in general and how Chris Thornburg thinks we're going to be bouncing back. But let's talk some real estate. Here's a survey. 25% of home buyers are moving or moving sooner than planned because of the pandemic. So this is really interesting. Low mortgage rates, spending more time at home, and working from home are driving forces for people moving due to the coronavirus pandemic. And we've talked a little bit about this. There's been a number of articles like this over the last several weeks. This one is from last week. And it's a somewhat counterintuitively, the coronavirus-driven recession is propping up the housing market. This is according to Redfin chief economist. Homebuyer demand is surging despite the GDP taking a historic nosedive in the second quarter. And that's largely because Americans value the home more than ever and are willing to prioritize housing even as they look to cut back other expenses. The large share of Americans looking to move as a result of the pandemic is one reason the housing market is booming despite high unemployment and an uncertain economy. So very, very interesting.
Well, you figure all the shelter in place, people are going to have to stay home more in theory, right?
Right.
Not going out there.
Well, and we got an article from one of the leading, Edward, you forwarded this email to Nam and I today, from Tracy McLaughlin, who's a leading realtor in Marin County in San Francisco. And she says that as a result of the pandemic, Buyers are more focused on private, separate, and fully contained home offices with appropriate audiovisual equipment for Zoom calls and video conferencing. Secondary homes that are separate from the great room, or secondary family rooms that are separate from the great room. That way, growing children can have autonomy and space to play with a separate space for Zoom learning. Another feature that she says are very popular right now, water features, especially pools, are creating demand for homes like she has never before seen. Even in communities that are a bit cooler, which I'm assuming she's saying like Tiburon, Sausalito, and San Francisco, demand for pools have really increased. Homes in the hills with immediate access to both biking or hiking trails are selling for more money than she has ever seen before. Mm-hmm. Even homes far up the hills, which have been challenging to sell, if the home is renovated and very close to trails, it will sell for a higher price today than it would have even 6 months ago.
I guess, again, people, what can they do for recreation? A lot of it's hiking.
Right.
Yeah.
Yeah, and you were mentioning earlier, Mark, how much people value their homes right now and are willing to spend more. People are also spending less on just discretionary things like, well, they can't travel. They're not, I don't know the last time I had my dress shirts dry cleaned. I don't even need dress shirts, right?
That's a good point.
And so a lot of things that people, gas, people are spending less money on gas because they're not traveling as much. So
although you say they're spending less money on gas, but other items that are flying off the shelves, SUVs, RVs, bikes, and boats.
Yeah.
And it's not hard to understand why. Yeah. When you can't go to Hawaii or Mexico or travel to Europe, and you got to stay close to home, or maybe grab an RV and travel. So yeah, SUVs. Most of the most popular SUVs right now are on back order. So
and fishing too, man. Everyone's grabbing my fishing spot. They're all going to the local lake.
You got to start charging.
Killing me.
We got a couple minutes here in this segment. I want to just say experts weigh in on the remarkable strength of the housing market. We'll finish with the housing market for this segment. So Ivy Zellman, who's a noted real estate expert, says, whether in terms of pending contract activity or buyer demand ratings, the various measures of demand captured in this month's survey can only be described as shockingly strong in spite of resurgence in COVID-19 cases. Housing Wire says existing home sales are still down year over year by 11%, but as crazy as this might sound, we have a shot at getting positive year over year growth. A Zillow economist says, in a remarkable show of resilience, the housing market has stared the pandemic right in the eye and hasn't even blinked. Chief economist for another research company, the housing market recovery has been nothing short of remarkable. The expectation was that housing would be crushed, and it seemed like it might be for about 2 months, and then it came roaring back. So unfortunately for those people that laid down the money for for how to make money in the coming real estate crash, they're gonna have to wait a little bit.
Yeah, you're shorting real estate stocks. That's all you're hurting right now.
Yeah. So, and they have many more than that. It's just, it's amazing. So, at the Best of Investing, the three of us are all very much involved in mortgage investing, investing in mortgage debt. So we're very keen on what's happening in the real estate market and what's happening in the mortgage market. And both of those markets, both the real estate market and the mortgage lending market, remain incredibly robust and strong and resilient in spite of all the crap that's happening out there. And there's a lot of businesses that are failing right now, a lot of people that are in economic hardship. But for that market that our investors are most concerned in, which is the resilience of real estate debt. We're going to talk a little bit more about that in the next segment, about why you should be looking at real estate debt as an investment strategy for earning exceptionally high returns.
And how the Pacific Private Money Fund is outplaying all the other, what do you call it? You guys are paying a higher rate of return than some other debt funds. So you're outpacing.
That's right. We're outperforming other California debt funds. Yes.
All right. Cutting to the second trivia question. You guys remember the movie Ferris Bueller's Day Off?
Oh, yeah.
Oh, yeah. Okay. Well, this is a little bit of a harder question, though. In the topic is entertainment. In Ferris Bueller's Day Off, what actor was listed in the credits simply as boy in police station? So he,
Oh,
yeah, so he hadn't,
yeah.
made it big yet, but definitely you'll know the name. He'd be
Boy in police station.
boy in police station. That's all he got credit for. All right,
All right.
call 888-912-1190. First caller with the correct answer is going to win that tanning certificate. Again, in Ferris Bueller's Day Off, what actor was listed in the credits simply as boy in police station? When we come back, we're going to talk about the Pacific Private Money Fund and also a new fund that has a preferred return of 9% with a target yield of 12%. You're not going to want to miss this segment. Make sure you stay tuned. Don't touch that dial. We're going to be right back. Welcome back to the Best of Investing. Again, I'm Edward Brown, your host, along with Mark Hanf and Nam Phan of Pacific Private Money. Second trivia question. In Ferris Bueller's Day Off, what actor was listed in the credits simply as boy in police station?
That was Charlie Sheen, right?
Very good.
Yeah. I watched that movie so many times.
Wow, I'm impressed. Okay.
When he was young and handsome.
Yeah,
And not scary and crazy looking.
Yeah.
So,
Winning.
So for the audience out there, the Pacific Private Money Fund is a debt fund. But the interesting thing, especially for the listeners who have been with us for a while, can you tell us why your fund is outperforming many other funds?
Well, it's true. So the Pacific Private Money Fund has been outperforming many, if not most, other California mortgage funds, particularly this year, with the caveat being unleveraged funds, because the Pacific Private Money Fund is a non-leveraged fund. We don't use leverage to boost our yields. And we've been paying, we launched it in 2013, and for the last 7 years up to this year, we've been ending each year at or near 8% on the fund member yield, on the investor yield. This year to date, through June, we're at 7.5%, a little bit higher for those compound investors, those that are growth investors and let their earnings buy more shares. The distributed yield is right around just a little over 7.5. But in June, we just did a distribution, and it was down a little bit at 7%, again, annualized, just for the month of June. Year to date through June 30th, still 7.5%, but for the month of June, the distribution was calculated at just a tick over 7%. And a couple of members reached out and said, hey, is this a trend? And no, we don't believe it is. And in fact, one of the reasons why it just wasn't as high as some of the other months that we do is that one of the things we do with Pacific Private Money Fund is because we have so many buyers of our loans, and we generally fill up the fund very quickly with good, strong, solid performing loans, that we're able to sell loans out of the fund and then redeploy that fund capital into a new loan. And why that matters is because we do share the origination fees, the points that we earn up front every time a new loan is originated. And especially if we originate a new loan and then within, say, 30 days we sell that loan to one of our institutional partners, all that fee income gets recognized right away as opposed to accrued. Not to get into a mind-numbing accounting conversation here, but long story short is because we, while we do have a portfolio of performing loans, we are able to sell loans out of the portfolio as well to institutional buyers and redeploy that capital and earn a higher yield. So most mortgage pool funds are rather static. Their portfolio is deployed, or their money is deployed into longer term hard money loans. In fact, many lenders are making 2, 3, 4, 5-year loans, maybe even longer. And so they don't see that kind of fee income. It's just the steady income from the interest rate. And so you'll see a lot of, very reputable mortgage pool funds in California that are paying in the high 5s, low 6s. Maybe they're approaching 7%. But a very well-known California-based fund stopped making or diverted much of their income this year into a loan loss reserve and has only been distributing in the 1% range, basically gearing up for what they saw for their particular portfolio as a high number of non-performing loans. So, there's a lot of you have to be careful when you invest in a mortgage pool fund. There's a lot to know about the nature of the management of that fund. And so for the Pacific Private Money Fund, we're very, very active in making short-term loans, selling loans out of the portfolio, revolving the capital of the fund so that the yields that our fund members are enjoying are about 100 basis points higher than the average unleveraged California mortgage pool fund.
And what about the spread? Isn't there a spread also?
The spread, no, that turned out to be a little bit too hard to account for. I know what you're asking about, but no, we're not able to share the spread because the accounting became a nightmare. So we continue to split the fee income, the origination fee income with the fund. And of course, every now and again we get an REO, and we've been really successful with repositioning that real estate and selling those REO properties at a profit. In fact, we got one that's almost ready to put on the market right now that's going to juice the yield up very nicely in the second half of 2020. So we predict the Pacific Private Money Fund will end 2020 between 7.5% and 8% on the investor yield. So again, past performance is not a promise of future results, and you must be an accredited investor in order to invest in the Pacific Private Money Fund. So this is not a solicitation for you to invest in the fund. In order to invest, you need to qualify and you need to read our offering documents. So for more information, you want to reach out to us at pacificprivatemoney.com. That's our website, pacificprivatemoney.com. There's a bunch of information on the Pacific Private Money Fund that's available online. You can also call us, and we're happy to email you the prospectus. Our phone number is 415-883-2150. Again, 415-883-2150. We never push the sale. We believe in attraction rather than promotion. This either works for you or it doesn't, and so you're not going to get any hard sales pitch from us. So when you call, don't feel like you have to have your guard up. You're just looking for information, and we love providing it. So.
And I'll add too that we'll be holding another information session in mid-September. So we'll be talking about the Pacific Private Money Fund and other investment opportunities. Okay. Stay tuned. We'll have it out there, an exact date and time. And it's been well attended over the last few months. It's because everyone's at home.
Everyone's used to Zoom meetings. They know how it works now. It's not like newfangled technology.
Everyone's an expert now.
That's right. I don't need to see anybody in person anymore. I can just do everything over the phone. All right, guys, going to cut to our next commercial break here. Boy, Nam, you impressed me with that last one. That was pretty good. Entertainment here. Mork and Mindy was a spinoff of what TV show? Call 888-912-1190. First caller with the correct answer is going to win that tanning certificate. Hey, Mark, by the way, what's the basis of the, the loan that you said that it's an REO and you're going to make a profit on? How much you into it?
So the basis is about $750,000. We think it'll sell for over $1 million. I have a special agreement with the contractor on a small profit split, but it's going to definitely be a significant income boost to the fund. So that's going to probably happen in Q4.
All right. Stay with us now. The next segment, we are going to talk about our new fund that's going to target 12%, but it's got a preferred return of 9%. Excuse me. Don't touch that down. We're going to be right back. Welcome back to the Best of Investing. One more time, I'm Edward Brown, your host, along with Mark Hanf and Nam Phan. Third trivia question: Mork and Mindy was a spinoff of what TV show?
Happy Days.
Happy Days. Here again. All right. So
I did not know that.
We were teasing.
Mork was Fonz's long lost cousin.
Was he?
No. I don't know.
All right. So we were teasing the audience about the fact that the Pacific Private Money Company has launched a new fund. Tell us about that fund.
How about you can tell us about it?
Yeah, I can tell it too, but my voice is hurting, so I'll let you tell it.
All right. Okay.
Nice.
So one of the things that we're pretty good at, I think, at Pacific Private Money is, well, first of all, we're a collection of real estate investors, real estate professionals, 30 years, 20 to 30 years each in real estate experience. And last but not least, we're very entrepreneurial here at Pacific Private Money. We're always looking for new opportunities to make money, directing the flow of investor capital. That's what we do here at Pacific Private Money. In a nutshell, at the end of the day, we earn fee income for directing the flow of capital from people who have capital looking for yield to people who need capital because, quite frankly, the banks have let them down. Over the years, the unbanked has grown, and companies like Pacific Private Money and other alternative lenders have found, business model that thrive. So in the course of the last few years, we're always being introduced to new people with new business models and new opportunities. Of course, we don't say yes to all of them. We investigate, just like the loans we do. We say no 9 out of 10 times. I would say that's probably pretty true for people who come to us with collaborative opportunities. 9 out of 10 times, it's like, yeah, that doesn't really fit. But about a year ago, Edward introduced me to someone out of Lubbock, Texas, that he was doing business with, buying seller carryback notes, mostly first position performing seller carryback notes. Now, if you live in California, and like I do, and I'm a native Californian, you might not know that in other states, particularly in the Midwest, Texas and surrounding states, that a lot of real estate, a significant amount of real estate is sold where the seller of that home carries back a note. And one of the reasons why that's a big thing there is that a significant portion of the population in those states are immigrant, either born of immigrants or immigrants themselves, may not have good credit, and it's just homes are priced less, so it's just a more common practice culturally where the seller of a home just knows, okay, I'm going to take a down payment, I'm going to carry back a note at 6 or 7 or 8% ish, and generally those are 30-year notes, and there is a market for people who want to liquidate those notes. Maybe they've been holding it for 5, 6, 8, 10 years, maybe even 15 years on a 20 or to 25, 30-year note. And a life event happens and they want to cash out. They want to convert that receivable, that secured receivable, into cash. And what ends up happening is that there are experts out there that send mailers on a regular basis out to people who hold these notes saying, hey, we can convert that note to cash. And this gentleman that we met in Texas has been doing just that for 20 years. And he was looking to match himself up with a company that could help him grow that business model of his and raise the capital. And we spent Edward and I, about 6 months visiting back and forth with this gentleman, and we came up with an idea for the Pacific Southwest Note Fund. Pacific Southwest Note Fund. And so we've already started raising capital in that fund, and we've designed that fund in mind based on this gentleman's 20-year track record of being able to purchase loans, performing loans at discounts, so that basically the internal rate of return on those purchase notes are anywhere from 10 to 20%. And we modeled the fund with the idea that with those types of average rates of return that we could produce, that we could commit to a 9% preferred return with a stated target of around 12% plus or minus on the annualized return with monthly distributions. So we're pretty excited about that. What did I miss, Edward?
No, it's pretty much in a nutshell. I mean, I've had experience with this now for a couple of years, and so far every borrower has paid like clockwork. I figured I'd be the guinea pig just to conceptually. I understood it, and I thought it made sense, but I didn't want to have a start a fund or get clients involved until I tested the waters myself. And
right, you in fact right now you presently own a portfolio of notes that you've purchased through this company
Yep.
that ultimately you're going to probably sell into the fund as the fund raises capital.
Correct.
Some of the metrics for how this works is, for example, a $100,000 a performing loan with a remaining principal balance of $100,000. They call that the UPB, the unpaid principal balance. Maybe the note started out at 150, and 7 to 10 years in, it's down to $100,000. We purchase those performing notes at roughly 65 cents on the dollar. Sometimes a little less, sometimes a little more, depending on what the note rate is. Let's say the note rate is 6%. There's a remaining balance of $100,000. We've been buying, or our now partner, has been buying those notes for on average about $60,000. So you have a $60,000 basis as a buyer of that note, but the unpaid principal balance and the payment is based on a $100,000. So you can see, if you do a little math, you can determine what the internal rate of return, what your true interest is. And when you have a portfolio of loans where your cost basis is 65% of the unpaid principal balance, you've got automatic equity built in. And you know what happens on some of those loans? Sometimes they get paid off because the property sells or they refinance. Now all of a sudden you get an even higher income boost, because if they owe you $100 grand and you only paid $65,000 for it, well, guess what? You get a whole $100 grand when they pay you off. Yeah. So it's pretty amazing. And we looked at the numbers. We with a 20-year history, our new partner, whose name is also Mark, Mark could pretty much tell us, down to the percentage of, what percentage of notes pay off early, what's the average duration of the hold, and what the average discount is. And it's an amazing opportunity now. So this is different. This fund doesn't compete with our other California-based funds, which are true mortgage origination funds where we make the loan. Instead, with the Pacific Southwest Note Fund, we're identifying holders of notes that need liquidity, will accept our offer, and it has to be an offer that works for us. If they want too much money, it doesn't work. So it's a pretty amazing model, and we just launched it as of August 1st. We've already put a few deposits into our subscription account, and we're off and running. And I haven't been as excited about a new fund as I am about this one. I know Edward certainly is too.
Oh yeah, I mean, the best part about all this is not a single borrower has been late by more than 30 days, and nobody's asked for deferment. Nobody's claimed COVID or anything like that. These borrowers pay. Anyway,
right.
that's
so for more information, PacificPrivateMoney.com, 415-883-2150. You must qualify to invest in the Southwest Note Fund. You must be an accredited investor. We can give you all kinds of information if you call us for more info.
Very good. All right, we're going to cut to our last commercial break. Don't touch that dial. We'll be right back. Welcome back to the Best of Investing. Last time for today, I'm Edward Brown, your host, along with Mark Hanf and Nam Phan of Pacific Private Money. No trivia question, but Nam, you got a deal of the week?
I have a deal of the week, and then you have a deal of the week too, right? The deals of the week. Actually, this are multiple deals. It's interesting. We always talk about our bridge loan being one of our primary loans that we offer to people, primarily for the buy before sell that we're seeing in the marketplace. I've never seen a higher number of bridge loans where people are coming to us before they found the next home that they want to buy. Essentially, typically, we're getting referrals from people, mortgage brokers, realtors at the 11th hour when somebody says, hey, my home's on the market. I want to make an offer on this house now, but I need to make it non-sale contingent because I'm competing against all cash. And while all cash is back, no low or no sale contingencies offers are back. Multiple offers are back. And so, our bridge loan is getting out there where people are coming to us and saying, hey, I'm going to list my home. I'm going to make an offer. I want to get prepared for that. I want to apply for your bridge loan first, get approved, and then I'm going to go out and start making offers. So people are being proactive and coming to us. And right now we have so many loans where the property is to be determined because they want to get the approval process out of the way first. So this ties into everything that Mark talked about in the first segment, which is real estate right now is super hot. And if you are out there looking to purchase, you really need to have your ducks in a row to be able to compete in this ultra competitive market. New builders, there's an article this week about the new builds. Builders are really tight on inventory. And if you want to buy a home from a new builder, you better not have a sale contingency because you're not going to get that home. So people are coming to us who are buying in a new community and getting a bridge loan so that they can buy that new home, even if it's not done yet, at least secure the close with our bridge loan, and then they'll pay us off once they sell their departing residence.
Yeah, qualifying them, you haven't made any money yet because they haven't identified the property and closed the deal. So you're just doing preliminary work?
Yeah, we were doing preliminary work, which is great for us because now we know, the borrower, we're not under as much stress, and neither are they, to get the approval process, get the documents to us that we need to qualify that they can, afford our bridge loan, give them time to work for their mortgage broker for the takeout loan. So it's a great spot, and it's better all the way around for getting a loan in place and being able to put your best foot forward when you're actually ready to make an offer.
Very good.
So the bottom line is it's a hot real estate market. If you have a home to sell and you're looking to purchase, then get your ducks in a row. Get qualified for a bridge loan, get qualified for the takeout loan, and then when you're out there ready to make an offer, then you'll be in a much, much stronger position to actually have everything go smoothly.
And for those buyers of real estate or realtors who need to get a hold of you to set this up?
Yeah, give us a call, 415-883-2150, or you can go to our website, www.pacificprivatemoney.com. And if you want to submit a scenario, go to the borrower page and click Get Started and let us know what your story is. And then we'll get back to you right away and let you know how we can help.
Very good. All right. So you can call that number, 883-2150, area code 415, on whether you're a borrower or you'd like to be an investor in any of the funds. Again, we got the new fund that's paying 9% preferred. Not bad. The Pacific Southwest Note Fund. All right, guys, we're going to here's our thoughts for the day. So my wife just found out I replaced our bed with a trampoline. Man, she hit the roof. And Adam and Eve were the first people to not read the Apple terms and conditions. Ba-dum-bum.
Right.
And lastly, I've been repeating the same mistakes in life for so long, I think I'll start calling them traditions. All right, tune in next week to The Best of Investing. We're going to be giving away more free prizes for answering trivia questions. Thanks for listening. On behalf of our team, I'm Edward Brown, wishing you the best of investing. So long.